Tax shift. What happens if the poor pay nothing and the rich pay more? The debate over tax fairness often circles back to a simple question. What if lower-income Americans were exempt from taxes while the wealthy paid a larger share? To explore this, we examined how such a shift would realistically function using insights from AI analysis. The results reveal complex trade-offs, funding gaps, and behavioral responses. Current tax landscape. The poor already pay little. The U.S. tax system is structured so that tax rates increase with income. Lower-income households already pay minimal federal income tax, thanks to credits like the Earned Income Tax Credit and the Child Tax Credit. In some cases, these credits result in refunds exceeding withheld taxes. However, lower earners do pay other taxes, Social Security and Medicare payroll taxes. These fund essential programs. State income taxes, applicable in many states. Sales taxes on everyday purchases. Property taxes, if they own property. Eliminating taxes for lower earners would therefore require removing payroll taxes, not just income taxes, to achieve true exemption. Zero taxes for the poor. Short-term gains, long-term problems. If lower-income households stopped paying both income and payroll taxes, the immediate effects would be increased take-home pay, directly boosting disposable income, reduced financial stress, easing burdens on struggling families, lower poverty rates, potentially lifting some households above the poverty line, increased consumer spending, stimulating local economies as lower earners spend a larger share of their income. However, this shift creates a significant funding crisis. Payroll taxes are the main source of revenue for Social Security and Medicare. To maintain these programs, policymakers would need to reduce future benefits, potentially cutting payouts to retirees and beneficiaries, raise taxes on higher earners, increasing the burden on wealthier individuals, increase federal borrowing, adding to the national debt, shift funding from other programs, diverting resources from existing government services, higher taxes for the rich, revenue boosts, behavioral shifts. Higher-income Americans already contribute a large portion of federal income taxes. Increasing their rates could generate more revenue and reduce income inequality. The potential benefits include additional funding for government programs, supporting education, infrastructure, or healthcare, lower federal deficits if spending remains constant, expanded social safety net programs, strengthening support for vulnerable populations. But higher taxes on the wealthy also create incentives for behavioral changes. Income shifting. Wealthy individuals may move income into lower tax categories, e.g., capital gains. Tax planning, increased use of deductions and loopholes to minimize liabilities. Investment changes, altering investment decisions to avoid higher taxes. Capital flight, moving assets to jurisdictions with lower tax rates. The overall impact depends on the scale of the increase and which taxes are affected: ordinary income, capital gains, or corporate taxes. Conclusion: taxing the poor less and the rich more seems attractive at first, but requires deep structural changes. It's not just about income taxes. Payroll taxes are central to funding Social Security. The wealthy may respond by shifting income or moving assets, while the poor may benefit from immediate financial relief, but at a potential long-term cost to social programs.